Well, welcome to the Ellsworth Advisors monthly wrap-up call for the month of May. Today is June 2nd, and I'm Kelly Kuennen. As usual, today I'm going to go through two different things, or a couple different things. First of all, a little bit of review what happened economically and some of the events in the month of May, and then talk about how that affected the portfolios, how they fared, some of our winners for the month. Last month was a pretty good month for the markets, so we'll focus on that and really what we see coming down the pipe for the next month or so, or next several weeks. From an economic standpoint, May, kind of a important month. Finally, the economy is starting to open up a little bit from the coronavirus lockdowns or stay-at-home orders. And I would say the opening looked pretty promising, especially in the Cleveland area. Traffic is definitely increased on the roads. Restaurants, people are now able to eat in the restaurants, so you're seeing economic activity pick up. First quarter, I think we may have talked about this a little bit last month, but from a GDP standpoint, first quarter, the latest GDP number for Q1 was a negative 4.8%. We are now in Q2, call it a month into it, and most of Q1 was helped because part of the month there was not a shutdown. In this quarter, we're going to have the first part of the month is going to be in shutdown. Expectations this quarter for GDP, I've seen expectations anywhere from negative 10% to negative 50%. I think that 50% is probably a little excessive on the downside. And also, once again, it's with businesses starting to reopen in May, halfway through the quarter. Is that 10% a good number? Could be. I'm expecting something definitely double digits. And stepping back, when we talk about a recession, really the technical definition of a recession is 2 quarters with negative GDP growth. And that growth, that 4.8% negative number for the first quarter, that 4.8%, that's actually an annualized number. But when we look at second quarter growth, that's going to be the decrease from first quarter to second quarter. Like I said, the expectation is definitely going to be double digits. And with things starting to reopen, when we go into third quarter, I have a feeling because businesses are starting to reopen, we'll have a month and a half of reopening, probably a good chance that third quarter will be an improvement from second quarter, which means we could very well see positive GDP growth, which means this recession probably is going to last 2 quarters. So it's just basically a technical recession. The depth of it, in my lifetime, I've not seen a 10+% negative growth in the GDP. So the depth of the recession is definitely, I hate to say the term unprecedented, but yeah, we're going to have a very deep recession. But at this point, it looks like it may be short-lived. One, question is, okay, if we see growth third quarter, maybe some growth improvement in fourth quarter, is there a chance of seeing some negative quarters moving forward? I think that's very possible. It's just how much more traction is the economy going to gain moving forward as we progress, through the future quarters. Another reality is, even though the economy is going to be growing again here in the probably not too distant future, when will it reach levels pre-coronavirus, pre this recession? Now you're looking at a lot longer time frame. Right now, a lot of economists are thinking 2022, 2023, 2025. The damage that was done in these last, 8 to 10 weeks, 12 weeks has been great. So it's going to take a while for us to actually get to levels where we were before that. Once again, we're only looking at quarter to quarter, month to month, that it is going to improve. But to get back to pre-recession levels, that's a big wild card when that happens. How that relates to the markets, that's, might as well start digging into that right now. So last month, like I mentioned, was a good month. The Dow Jones for the month was up 4.8%. Year to date, the Dow Jones is still down about 12.22%. Now, this is through the end of May. I'm getting my numbers from Y Charts. That's basically our data information service that we use. So that's the Dow Jones. The S&P 500 has fared a little bit stronger than the Dow Jones. S&P 500 for the month was up. Well, for the month was a little bit slightly less than the Dow Jones. For the month, it was up 4.53%. Year to date, the S&P's down 5.77%. So we're seeing a fairly large disparity between the Dow Jones and the S&P 500. And one of the reasons that dynamic exists is the Dow Jones that index is really looking at 30 stocks that are meant to represent kind of a broad swath of the U.S. economy. The S&P 500, that index is really the 500 largest publicly traded companies, and then they're weighted based on the size of the company. When we talk about size, we're talking about number of shares times share price. So you have more companies in there, and the weighting right now is it's heavily tilted towards a lot of tech stocks, whether that's Apple, Amazon, Google. Those stocks, they've continued to do well. They push the index, and specifically when we talk about the S&P 500, a lot of analyst strategists are questioning, it's come back too fast, too far, and the index as a whole, those are the numbers. But when you start thinking about the weightings, and if you break the index into the components of it, basically through all this, through the crisis, some companies have actually been winners. So some companies, their businesses have expanded. They've continued to do, generate revenues, generate profits, and a lot of those companies have been the tech companies, working from home, Zoom conferencing. The technology side of it, those businesses continue to be strong because people continue to use them. It's not like a more traditional recession where all business basically dries up or really slows down, which is more broad-based. In this situation, there are industries, companies that are doing fine. Home Depot, home improvement type companies are doing fantastic because people are home, they're doing stuff. And not everybody's been affected by a reduction in income. Even the unemployed are seeing enhanced unemployment checks, which there's still more consumer spending going on. So those are the winners. We also have a group of losers that have been seriously affected by this. But great examples, your travel industry, your airlines, your hotels. Energy has been on its back for a while. Actually, oil prices have increased in the last month or so. And part of that is because people are starting to drive again. But those the losers, if you want to call them the losers, a lot of those companies were in maybe, I wouldn't call financial straits, but maybe not in the greatest financial positions going into the downturn. And obviously they've been, seriously affected. We're going to have companies that, basically will go bankrupt, will fail at some point. But the makeup of those companies, they represent a small portion of the S&P 500. The winners, those top companies that drive the index, they represent, close to 30% of the index itself, whereas the smaller, the loser group represents closer to 5% of the index. So once again, that kind of explains the dichotomy in the index. But that middle segment, call them the others, are more your rank and file type companies. Good example would be AT&T. AT&T's business, I think when we look quarter over quarter, probably hasn't changed a whole lot, continuing on the same trajectory it's been on. Their business has remained the same. Profit margins are the same. They're kind of, continue to plod along. There's a large swath of business or companies that fall in that category. Those companies, they felt the drawdown, the lows of March 23rd. You saw the losers kind of had a bounce, but a lot of those have retreated back to their lows again. Those middle companies, they came down, bounced back, pulled back a little bit, and now they're kind of hanging around in the middle, if you want to call it like that. So when I see the Dow down 12, S&P down 5.7, it kind of makes sense in that, the worst is probably behind us, but we're definitely not to levels we were previously. And it will take some time to get back to those levels. And how that, really, when we look at how we invest dollars in the stock market, we're choosing individual companies. So, our goal is to weed out the losers, focus on the winners, And those companies that are in the other category that we feel, okay, long term, they are going to be solid long term investments. We don't, some of the winners we don't hold because in the grand scheme of things, we're not real comfortable with how they're valued. So we feel like they were overpriced going in, they're still overpriced now. We're looking for more reasonable valuations on in a lot of our portfolios. So that really addresses the large cap stocks or large company stocks when we talk about the Dow and the S&P. In the small cap arena, we use the Russell 2000 to kind of look at small company stocks. And last month, small company stocks had a good, strong run. For the month, the Russell 2000 was up 6.36%. Year to date, the Russell's still down 16.45. So small caps are always more volatile. They definitely took it on the chin harder than large caps. They've bounced back well. It's just they have a further ways to go to bounce back. In the emerging market world, the emerging market stocks were up 0.59%, so not a real strong month for emerging markets. Year to date, they're still down 16.53. And we look internationally at the developed world, not counting the U.S. The MSCI EAFA for the month was up 4.07%. Year to date, still down 15.31. So, the message that tells us is the U.S. has basically handled this the best, and the U.S. markets have come through this the best so far up to this point. And I think, because we're one country versus multiple countries, that definitely gives us an advantage on how we've addressed things. And, naturally, in times of crisis, money does flow to the U.S. just because of, the financial system that the U.S. offers, and it's just a fact of life. We still are the reserve currency of the world. So that's kind of what's happening in the markets in general. How that translates to our portfolios, our growth with income portfolio, which is really our balanced portfolio, for the month, had a good strong month, up 4.28%, a little better than what I would have guessed going into the end of the month. Year to date, now the reality, because we use this portfolio with a lot of clients, some clients have money coming out of it on a monthly basis to supplement their retirement funds and so forth. We've seen clients anywhere from down 2.3% to down 3.5-4%. So that's held year to date. So that's held up pretty well. Most people are in that 2 range, so that's been pretty solid. The winners for the month: Cisco was up 12.8%, Nvidia up 21.47%, Nike had a nice rebound, up 13%, Visa up 9%, Disney's come well off its lows, up 8%. Year to date, Nvidia has been a big driver of ours, almost up 51%. Apple's up 9%. We've held gold for well over a year now. Year to date, gold's up 14%. Last month it was up single digits. But that's been a good position for us in the growth with income portfolio. Price potential portfolio, which is a 20 stock portfolio, really on the growth end of the spectrum. For the month, we're up 4.37%. Year to date, we're down 9.08%, and that kind of falls between the Dow and the S&P. We do have some tech holdings in there, but we're a little more conscious of valuations. So to be kind of between those two, between the S&P and the Dow, doesn't surprise me. Big winners last month: S&P Global up 11%, Aon Insurance up 14%, Google up just under 6%, Target was up 12%. We did just buy Alamo Group, not the car company. They're up 6.46%, and then Estee Lauder up just under 12%, 11.49%. So, good moves last month in the price potential. Dividend yield, which is really our more conservative stock portfolio, dividend-oriented, obviously, based on the name. Month to date, 3.52%. Year to date, down about 9.29. Typically, this is tends to run more in line with the Dow. We outperform the Dow. Generally, don't expect it to outperform the S&P. In dividend yield, last month, our big winners were Blackstone up 9.5%. LyondellBasell, basically a multinational chemical company. Lyondell's been struggling. Last month kind of regained its footing, up 10.91%, so just under 11%. Good recovery there. UPS had a good month, 6.24% up, and Waste Management up 6.92%. So that's kind of who the winners were in the dividend yield portfolio. In the small cap arena, our small cap portfolio relative to the index, I think, has performed very well. Month to date, 6.85%. Year to date, we're down 10.23%. So really, year to date, I've been really happy with the small cap portfolio. It's hung in there well. It's definitely a more volatile portfolio, so we don't hold that in all our clients' accounts. It's really more for the more risk tolerant. Bigger swings every month when we talk about it. You hear bigger numbers here. Month to date, big winners in there. EverQuote up 38%. Tech Target up 17.88%. Acushnet Holdings, basically they make golf equipment, up 21.97%. Solar Edge, 27.16%. First Capital, 23.27%. eHealth, 22.23%. So some good movement in the small cap arena. So last month, not too bad. Actually, a good month that last month. Expectations moving forward. So June, from an economic standpoint, earnings standpoint, kind of a quiet month. Second quarter earnings announcements will begin in earnest, call it mid-July, mid to late July. The expectation is, there's going to be some really ugly numbers because obviously, because of the shutdown, you're going to see, it's hard to put a lot of weight in these numbers. I think the winners will continue, showing good strength. Could see some good recovery numbers. Where expectations were definitely set very low. First quarter, second quarter, could see some improvement. That could drive some upward market activity, especially if you continue to see the landscape or more economic activity continue to open up as we get into late June, July. By that time, we'll see more things opening up. And the other reality here in Cleveland, a lot of stuff is opening up. We're seeing a little bit more return to normalization. But we have to keep in mind that New York, for the most part, is still pretty much shut down. And as they come online, that'll help drive, there's a large population there. So that may help drive numbers too as we get into earnings season in July. For the most part, I think we're maybe caught in a range a little bit with the market. My expectation is we kind of oscillate around. We're probably towards the high end right now, sitting over 3,000 on the S&P. I don't, like I said, in the short term, don't expect a lot more upside in the S&P in the short term. The downsides probably come up where I could see a 3 to 5% range from top to bottom, and we may oscillate in that range for the next couple months or at least several weeks, unless things continue to progress in a positive manner. The other thing we're going to see happen, and what I think we're really start to get into the election season here. So that's another really non-financial factor that will drive some of the headlines, and we have to expect volatility to continue. In general, clients' accounts, across the board, obviously everybody's different depending on how aggressive you are. But, some accounts, people, we're within shouting distance, getting back in the black. Our more, call it moderate clients are maybe down 2 to 4% at this point in time, year to date. So that's not an insurmountable hurdle to get to the positive, to get into the black. And, I'm thinking that could happen in the not too distant future. Our more aggressive clients, down in that 5 to 7% range. So once again, even that's not insurmountable with, kind of the direction we're going. And I believe with, just the style we're using and how we're investing the dollars, I think, at this point, it's not going to be a huge negative year. I think we may be able to eke out some gains this year through everything we went through and, kind of move forward from there. So that's where we're at right now. If you have any questions or comments, please reach out to us. Feel free to give me a call, and we'll talk to you next month. Have a great June.